Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at the banking sector on the Trinidad and Tobago Stock Exchange and two of those Canadian-owned banking giants that are publicly listed on the TTSE. We're talking, of course, about SBTT or Scotiabank Trinidad and Tobago, as well as FirstCaribbean International, or rather CIBC Caribbean, after their soon-to-come rebranding. Now, both groups would have reported varying earnings. Let's take a look at how they would have performed and what investors might expect in the coming months ahead. Turning firstly to FCI or CIBC Caribbean, well, the group would have reported an earnings per share figure of just around $1.12, which was a 51 or 52% increase from the 74 cents recorded in the prior comparable period. Now, total revenues would have improved just about 24% from 3.8 billion TT equivalent to just under 4.8 billion TT dollar equivalent. Overall, income before taxes up 53% from 1.26 billion TT equivalent to just around 1.9 billion, and net income attributable to equity holders increasing that 52% from 1.16 billion to 1.7 billion TT dollar equivalent. So certainly good reading for CIBC Caribbean investors from an earnings perspective. When we take a look at those revenue trends, well, it seems very positive for the recently concluded fiscal period for FCI at that 12-month period ended October 2023, with net interest income in that red segment increasing roughly 35% from $2.5 to $3.4 billion, with operating income a more modest gain of around 3% from 1.3 billion to 1.325 billion to 1.364 billion overall, that 24% increase in revenue attributable mainly to a higher US dollar interest rate environment. Now, that could be set to change in 2024, subject to certain timing changes and magnitude of benchmark rate changes, of course. That should have an impact on FCI's earnings potential as we move into fiscal 2024. From a profit before tax perspective by segment, we can see corporate and investment banking for FCI would have improved roughly 52% from just about 1.1 billion to 1.6 billion. Personal and business banking from 87 million to 149 million TT equivalent, a 70% odd increase. And wealth management would have been relatively flat, 71 million versus 74 million. Now, from a valuation perspective, and we're taking a broader look at the banking sector, we would notice that FCI, on a price-to-earnings ratio basis, is the most attractively valued stock on that local banking sector at 6.2 times versus the sector average of 14.6 times. And certainly when compared to some of its comparables who are trading in the high single digits than over 20 times in some cases from a price-to-earnings ratio perspective. So at that price of $7, again, FCI is trading at a price-to-earnings ratio of 6.2 times compared to that sector average, again, of 14.6 times. Now, the stock does offer investors a dividend yield of around 4.8%, which is above the sector average of 3.6%. And of course, one of FCI's value propositions is that it pays its dividend in US dollars. So investors buying an asset with TT dollars can generate US dollar cash flow. So certainly one of the reasons that investors keep a close eye on FCI. So with that high interest income in mind, overall revenue growth, attractive valuations, and a broader economic recovery at the regional level, Bourse is maintaining its overweight rating on FCI for the time being. Turning very quickly to Scotiabank Trinidad and Tobago, SBTT, for its fiscal year also ended October 2023, the group would have reported earnings per share of $3.85, which was pretty much in line with its fiscal 2022 earnings figure of $3.88, a marginal 0.8% decline. Net interest income was up 13.5% from 1.25 to just over 1.4 billion. Overall total revenues up just 2.1% from 1.9 billion to just 1.937 billion. Overall profits for the period down that 0.8% from 683 million to 678 million. When we take a look at Scotia's revenue composition, well, it is a starkly different story from FirstCaribbean or CIBC Caribbean rather. Net interest income again up that 13.5% from 1.25 billion to 1.4 billion. However, other income would have declined from 652 million to 523 million, a roughly 20% decline, contributing to that net more modest 2.1% revenue growth in the recently concluded fiscal year. Now, From an investor perspective, that may not be the best of reading, but still a positive reading in terms of overall revenue growth for Scotia. And when we take a look at what that has done in terms of dividend impact, well, again, a relatively consistent earnings per share from fiscal 2023 versus fiscal 22. However, dividends per share would have adjusted to a more modest $2.80 compared to the $3.30 in the first fiscal year declared in the prior comparable period. That payout ratio returning to more or closer to more historical levels at around 73% for Scotia when we consider the historical trend. So, of course, at that price of just under $70, Scotia is trading at a price-to-earnings ratio of 18.2 times, above the sector average of 14.6 times, with a dividend yield of a still healthy 4% compared to the sector average of 3.6%. So, with those increases in net interest income, over keeping an eye on those higher non-interest expenses, that those healthy dividends, as mentioned, and elevated valuations, Bourse is maintaining its market weight ratio on SBTT for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773. Email us at invest@boursefinancial.com. And of course, you can check out our website where all of our research is absolutely free on bourseinvestment.com, and catch this week's article in the business section of the Trinidad and Tobago Guardian newspaper. Well, however you choose to spend it, do have yourselves a very enjoyable, relaxing, safe, and fun-filled Christmas long weekend. Enjoy the festivities, and we'll see you next time on the Bourse Report. Happy holidays, everyone.